Guy Stear, head of research at Asia Pacific. He represents Societe Generale. He joins us live from Hong Kong. Guy, good morning. Thank you for joining us. What's happening in the world? Nobody's bothered about bad news. When bad news is coming out, money managers are making an excuse. When good news is coming out, markets are reacting to that.
I think that's absolutely right. I think what your previous commentator said in terms of the opening this morning is absolutely correct. After a decent close in the U.S. last night and even some fairly hawkish comments from traditional doves like Bullard on the Fed side, markets are getting optimistic in terms of stronger U.S. growth and a recovery after what has been a sort of disappointing start to the year in terms of economic data, at least in January and February.
So how does one invest in this kind of an environment? Because the news flow is not that supportive, and some would argue that at the current juncture, some degree of complacency has kicked in.
Well, I would say the biggest opportunities, let's take a step back. I would say there's two issues. First of all, from the U.S., I think the news flow will tend to get better in terms of economic growth. We have the payrolls figures on Friday. Our U.S. economists are looking for 275,000, which is a very strong figure, higher even than the 200,000 consensus. So we should start to see fairly supportive news flow from the macro side, at least in the U.S. I think the second issue, though, within Asia is that there are a lot of opportunities now for some rotation between markets after very divergent performances in the first quarter. So I would actually say that China, which has had a bounce in the last week and a half, is at the beginning of a recovery which could last for a couple of months, could take the H shares up to 11,000, and that's probably a very good opportunity to invest right now.
So you expect China would have greater upside from here, Guy?
Well, I think that the fiscal announcements that we had yesterday are a part of a trend which we've seen really since the growth forecast of 2014 of 7.5%. This was a higher growth forecast than we had expected, a higher official target, let's say, than we had expected. I think it's a higher target than most in the market were looking for, a surprisingly high target given the kind of cyclical slowdown that we've been seeing. And once we had that target, it was clear there was going to be some sort of policy support. Now the details of that policy support are coming out, and I think that's going to be a further reason to extend a bit of a bounce in the Chinese equities that we've seen.
Guy, what's the call on India then? Because we've seen a fair amount of rally in the last, year to date actually, and we're sitting at record highs as well for equities. It is backed by flows, the momentum that we're seeing in our markets right now, but the economy seems to be a little iffy at this juncture, and you've got a big overhang. That's the elections as well coming up. What's the call now on Indian markets?
Well, I think India has been supported both by global factors and by domestic factors. The domestic support had been the fact that people were very optimistic about policy changes which could take place after the elections. And then the global factors were the fact that for somebody running an Asian equity portfolio, because the situation in China was looking so difficult and Japan had been a bit of a disappointment early in the year, there was money coming out of those markets looking for another home in Asia, and India was one of the beneficiaries of this. We saw similar factors supporting Indonesian stocks and Philippine stocks this year. Now I think the fundamentals are changing. The issue for me in India is not so much the fundamentals, the macro fundamentals right now, because the production figures recently have been pretty good. The inflation figures recently have been pretty good. I think more the issue is the fact that there has been so much optimism going into the elections. There may be a bit of a buy the rumor, sell the fact reaction after the election. So that could be one trick for profit taking. And the second could be, as the Chinese situation starts to get more optimistic, people will have to take money out of other markets in order to invest in China. And India could be one place where they do take money out.
Guy, exactly a year ago, for the first time when US Fed mentioned the word tapering, everyone on the street said, oh my God, this is end of easy money. Money is going to contract now. But exactly after a year, even though the tapering quantum has come down from $80 billion to $55 billion, now the latest view is that, guys, focus on that $55 billion. The Fed is still printing money, which means there is a hell lot of liquidity in the world.
Well, that's true. I think the Fed has been at pains to try and make it very, very clear how tapering will take place. So I think that they'll continue to do about $10 billion of tapering per Fed meeting, which will mean that they'll keep adding smaller and smaller amount of money to the market up until December this year. I think the focus, though, will now switch from tapering to what they're going to do about interest rates over the next 2.5 years. And I think still there's some scope for a little bit of pressure on the emerging markets which have performed very well once we start getting into concerns about U.S. interest rates going up. So places which were vulnerable last year when we had what was called the taper tantrum could again be vulnerable this year when we start focusing on higher U.S. interest rates in 2015, 16, 17, and a steeper front end of the U.S. yield curve.
What's the view on commodities then? Does it seem like the dream bull run that we had in, gold as well as silver prices is now completely over, and one should say goodbye to the commodity investments?
Well, one of the striking things with commodities at the beginning of this year was how well they performed, despite the fact that there were growth concerns with weak U.S. economic data and also growth concerns with the slowdown in China. Our commodity strategists have emphasized the fact that commodities this year were really trading on their own domestic fundamentals, meaning the balance between supply and demand in the various different asset classes. So we had a number of factors like coffee prices being driven up by events in Brazil. We had factors like corn prices being influenced by events in the Ukraine. We did actually see lower U.S. interest rates and lower two-year yields in the U.S. supporting gold prices. But I do think that that may change once we start to see, again, higher U.S. two-year, three-year yields. That could actually have a negative impact on gold prices going forward.
Now, I don't know if you've noticed, but there is a similar trend within emerging markets. So markets like India, Indonesia, Taiwan, Brazil, or South Africa are on a tear, and they're doing much better than other emerging markets. And the simple linkage here is that all these markets which I have mentioned are due for elections. So maybe money is gravitating towards those markets where investors feel that a change in regime would change the economic outlook.
Well, I think in some cases that's true. In other cases, it's rather more difficult to argue that. I think I would interpret the performances of some of these markets rather differently. I think that some of them, and particularly places like India and Indonesia, which I'm closer to than the markets like Brazil or South Africa, have been beneficiaries of the fact that people have been negative about China since the beginning of the year and looked for other opportunities in which to put their money. I'm afraid that as the China story begins to look somewhat more positive in the second quarter, those money flows may reverse, and you may see money coming out of Indonesia and to some extent India as well.